Morning, ladies and gents. Simon Brown here for Friday, 27 March, our market standard. What we're going to do Friday is we're going to look at ETFs, exchange traded funds. In particular, I'm going to start with the ASHGEQ 1200 today. And I'm starting with that one because that's my sort of go-to global ETF. And we'll talk around why it is and the like. But I always get folks saying to me, what am I buying? Well, that is my stock standard monthly debit order. Goes off via ASI and looks at the ASHGEQ 1200. There's a bunch of others. As I said, we'll click into those. If you've got questions, drop them in the Q&A box. I'll answer as we go along if it's pertinent to that point in the presentation. If it's more generic, I'll come to it at the end of the presentation, but I will get to your questions. Don't worry about that. We've got plenty of time here today. So focusing exchange traded funds, and as I said initially, I want to kick off with the ASHGEQ 1200. The ASHGEQ Global 1200 ETF, tracking the Standard & Poor Global 1200. So the ETFs themselves, they obviously are the management companies of them, but they then track an underlying index. In this case, it's the S&P Global 1200. We know S&P, the most famous of S&P indices, obviously is the S&P 500, tracking the 500 largest stocks in the US. This is a global ETF, however. So its aim is to try and encompass 70% of the world market cap. In other words, if we look at all of the listed shares around available to an investor in the world, they're looking to capture 70% of that. And that 30% that's missing is going to be partly geographic, but also the very, very small stocks at the bottom. They don't call it a large cap index, but it is focusing on larger stocks. It's 7 distinct regions: USA, Europe, Japan, Canada, Australia, Asia, and Latin American. And within those 7 regions, we are covering 30 different countries. So it is great and diverse in the sense that it's picking up everything except Africa. And I'll touch more on that in a moment. Excuse me. The one weird point is, and let's look at the S&P 500 for a moment. And I'm going to come to this more in a bit, but we look at the S&P 500 and we say, it's an American index. It is an American index, but those shares within the S&P 500, those are global. Think of Apple, think of Microsoft. All of those different companies are global companies, and Apple is selling iPhones in Africa. They're selling iPhones in South Africa. So that distinction between geographies is really on where's the company headquartered, but their earnings are in many cases going to be from way beyond just where they are headquartered. For those who are index nerds like myself, these are the 7 indices that essentially they pull together. It's the S&P 500, the Europe 350, Topics 150 out of Japan, then the TSX 60, which is Canada, the ASX All Australian 50, Australia obviously, Asia 50, and then Latin American 40. And that's how we're essentially getting to those 1,200 shares. There's actually a slight number above 1,200, and I'll come to that. For example, our top 40, we call it the top 40, but it's actually running closer to 42 because some of those dual listed. Total expense ratio of 0.59% and a total investment cost of 0.7. Now, truthfully, this makes it a slightly expensive ETF compared to particularly some of the other global ETFs. I'll touch on that in a moment. Total expense ratio is the management cost for running the index. That management cost is including, obviously, the rights to the ETF, the processes, etc. And then that extra 0.1, which takes total investment cost, includes transaction fees. It's paying dividends on a quarterly basis, March, June, September, and December. What happens here is the index physically holds those 1,200 shares. And those shares are, during the year, not many, not all of them, are paying dividends. And as they pay those dividends, they're received by the ETF manager, in this case, ASHGEQ. And then once a quarter, they pay the dividend to you as a holder, plus any interest that has accrued on that dividend, less their fee. So that total expense ratio, total TIC of 0.7 would effectively be divided over 4 different quarters. What's that? Coming in at about 1.175 per quarter. Fund managers, ASHGEQ fund managers, trustees of Standard Charter, market maker, is RMB securities. Quick look at the sector allocation. Now, 2 points I want to make about this. Firstly, this is as of February 2020, which under normal circumstances we would say, well, 27 days later, what's changed? Well, potentially a lot has changed. Potentially a very lot has changed. But this is where it was sitting at the end of February. Technology, the biggest holding, no surprises there. Financials, then second, no surprise there. And that's typically what we see with global ETFs that are looking at developed market. We get technology, and then financials are typically your top two. Then we've got healthcare, consumer goods, industrials, specialist securities, those all at over 10%, consumer services, and then we really drop off to utilities at just over 3.25%, oil and gas at 3%, telcos, chemicals, base materials, excuse me, other, and then cash sitting at 0.5%. What's missing from here is retail investment trusts. In other words, your property stocks. There is property in here, but it is just under 0.5%. It is absolutely tiny. It is that small little sliver there, which is everything else, which does include some property in this particular space. The top holding stocks: Apple, Microsoft, Amazon, Facebook, JP Morgan, Berkshire Hathaway, Alphabet, Class C and A, which is essentially Google, Procter & Gamble, Johnson & Johnson. That top 10 list looks very, very similar to what you would see with an S&P 500 in terms of what the stocks are. A lot of folks worry that if they get into the wrong global ETF, they're going to miss out on the tech. The tech is still there. I mean, you can go heavyweight techs, and we will at some point. There's a NASDAQ, the One Invest, which has got a S&P 500 tech ETF, which is exclusively into the tech space. This is a diverse, so it's across sectors, it's across the different industries, and that list looks pretty much as it would for an S&P 500. Key difference, of course, slightly lower weightings. In the S&P, I think Apple's closer to 6%, Microsoft ditto, Amazon a little bit behind that. So you get some upweighting in those various different stocks if you take a pure S&P. Here's price chart. It's a relatively new ETF. It came out towards the end of 2017. So we're running only about 2.5 years of data. This is for the close last night, 26 May. There are two components that drive this ETF, and that's critically important. What happens is you invest into it, and you use your rands in South Africa using standard online share trader, using your tax-free account, or using Auto Share Invest sitting within Standard Bank internet banking. And you buy that ETF, Ashburton takes your rands, and they convert it into these multiple different currencies, and they physically go buy those 1,200 shares. So you've got two drivers happening here on the ETF price. The first is literally those shares. Obviously, those 1,200 shares, which as Ashburton's holding on your behalf, they are driving price. But the second is you've got currency movements. There's always going to be some currency movement as well. So as the rand is weakening over time, what you're going to see is essentially that would be a benefit to this ETF. If the rand is strengthening over time, what you're going to see that essentially it's going to be taking some of the shine off the scenario. Just check my audio there a sec. I'm getting some issues. I know what I'm going to do to solve that. I'm going to stop that. Folks, we always do record, so if we hit audio problems, sometimes it's my side, oftentimes it's it's the internet, and the internet is getting a little clogged these days. We are always recording. But back to what I was saying. So we've got two drivers on this ETF. One is literally the movement of those particular different shares, and the second, obviously, is going to be the currencies over time as well. A little bit around it, so it's a slightly higher total expense ratio than some of the other offshore ETFs, although truthfully there's some that are more expensive. It kind of sits in the middle zone, but I can already see some people coming through and saying, yo, this is an expensive one. Compared to some it is. You know what the beauty is? we sit in a world right now where a total expense ratio running at sort of 0.5 or even 0.6%, people look at that and think, yo, that's expensive. Oldies like me remember buying what was then in the day unit trusts, man, and we were paying, we were paying 2, 3, 4, 5, 6%. Yeah, there are ETFs out there locally at 0.1. There are global ETFs which you can pick up via web trader at 0.03%. So make no mistake, it certainly is a higher than its competitors, but we're in a sweet spot in 2020 where costs have come down, and that's a great thing. It's broader geographic than S&P 500, and that's why I prefer it rather than exclusively into an S&P 500. It has a little less US exposure, but what we see is that it's got that Japan, direct exposure into Japan, as opposed to the S&P 500, which has got companies, and again, let's use Apple as an example, that is undoubtedly selling cell phones in Japan. They sell an iPhone or an iPad or a Mac or whatever it might be. So they certainly got that business. But this gives you some more direct, and it's certainly picking up companies that will be much more focused on just Japan and the Japanese economy. As an example, there's the Latin America, there's also Australia. So it gives me that broader geographic diversification than the S&P 500, which is why I like it. It also includes directly 7% emerging market, and that emerging market exposure is Latin America and some Asia. It doesn't include any direct Africa exposure. And that doesn't hugely bother me because we, of course, are going to have other investment products, pension, provident, retirement annuity, all of those sort of products. And they're going to be Reg 28. And Regulation 28 means that they have to be buying percentages of JSE listed. Now, again, some of those JSE listeds are earning money beyond the borders of South Africa, but you're getting some South Africa and to a lesser degree African exposure via that. So I'm quite happy with when it says no Africa, because I've got that in my personal portfolio already. It also gives me a slightly lower concentration risk. Top 10 is only 10% of the index. Typically what we see is that top 10 of an index is usually between about 40 and 60%. And what I mean by top 10 shares. So the top 10 shares here, and it's because there's 1,200 stocks, of course, the top 10 shares here are literally 10% of the index. As I said, constituents are 1,219, although it is technically at 1,200, but that some of the stocks are dual listed, double listed in different markets, etc. And as I said, our top 40 has got, Mondi used to have London and Joburg, Investec, London and Joburg. So both London, it's one share, but both go in. So it's one share in terms of the top 40, but then when you actually do the index, you get the London listing as well. And then we had, who was it? Was it Fortress, who had A's and B's? So when Fortress went in, it's Fortress, but there's Fortress A, Fortress B. So don't stress it. We get a couple of extra shares there, no problem at all. Alternatives, I said I would look at some of the alternatives. You've got your straight S&P 500. We've got 4 of those, the ETF 500 from One Invest, a couple of others as well. And what we've got with those, that is just the pure classic S&P 500 that is being displayed on our TV screens every night and that we watch as a sort of metric for US markets. We've got global dividend aristocrats. This comes from Core Shares. And this is an interesting ETF. It's quite fundamentally different, and I will do it in one of our Friday sessions. It's quite fundamentally different to a normal global one. And what I mean by that is that dividend in the name is not focusing on high dividend yield. You're not going to get a massive dividend from this ETF. What it's focusing on is dividend as a proxy for quality. So, for example, the Global Dividend Aristocrats, for an American company to be included in that ETF, they have to have paid a dividend for 25 years consistently, which means, for example, no Apple. Because 20 years ago, Apple was almost bankrupt and wasn't paying a dividend. No Facebook, no Alphabet. Why? Well, because 25 years ago, Facebook and Alphabet didn't exist. It means no Berkshire Hathaway, no Warren Buffett, because Berkshire Hathaway doesn't pay a dividend. So what you get is you get companies that have been around for a long time and consistently pay dividends, And those are typically going to be what we call consumer staples. So it's your Procter and Procter and Gamble, Johnson and Johnson, sort of those companies that sell toothpaste and, what we would call, and we're not calling it in a nasty sense, what we would say are the perhaps, boring companies. The plan being is that those boring companies are probably less volatile. Of course, what we've seen in the last month, everything has become volatile, and that's a different story on its own, but nonetheless. So that is typically a less volatile. It's going to be, race to the moon less. It's going to fall down less because it's got more of those staples and a lot less of those new tech stocks in it. MSCI Developed World, we've got two. This is an MSCI index. We've got one from Signia, one from Satrix. And what this focuses on is a developed market. So it's 1,600 shares, 1,600, which is a lot. But the key point is developed market only. So no Asia, no Latin America, etc. Now, again, that includes the Apples of the world who are selling into developed markets. So certainly we do get some developed markets from it. Folks, that's the Ashburton 1200. If you let me know for next Friday what you're looking for, drop me emails. We've got contact details there. You're welcome to drop me a mail. And I just want to go through the schedule, what we're currently doing. So Fridays, we're going to look at exchange traded funds. Wednesday just gone, using the Standard Bank platforms. That is AutoShare Invest. Excuse me, online share trading. That will be WebTrader. I'm going to get Adishan Naidu in to come do some WebTrader for us, which is the offshore platform. It will also include Iris Viewpoint, which is the trading platform. So we'll look at the different platforms. And then Mondays, myself and Daneo will do the week that was and the week ahead. So, what were the big news points for the last week? What's happening? What research reports been coming out? All of that sort, all of it 10:30. If you're registered and you're here for this webcast, you will automatically be put in for the others as well. And then we're going to bring Tuesdays and Thursdays as well. Our plan is that you'll just have a regular weekday, 10:30. There will be a webcast coming out of standard online share trading across those different topics. Tuesdays and Thursdays, we've got some ideas. We plan to get that up and running as soon as possible so that we're running on a daily schedule. And then, of course, all the others are still happening. We've still got Warren Peacock doing his Monday morning 8:30 and the like. Those continue to go. At the bottom is the YouTube channel. We are uploading onto YouTube. You can grab them there. That is one heck of a channel code. So easier, just go to YouTube, search Standard Online Share Trading, and you will find the YouTube channel, and the videos will be uploaded onto those YouTube channels. That's it, folks. I got some questions coming through. I'll take the questions. There's contact details. You're welcome to contact myself. You're welcome to contact Standard Online Share Trading. If you've got ideas for topics, ETFs, etc., let us know. Let's get into these. If I invest in S&P 500, can I still buy the Ashburton 1200? You absolutely can buy it. The question is that there will be some overlap. So, for example, they've both got Apple. But there will be some stocks, particularly in the Ashburton 1200, there will be that extra 700 shares that you don't get in the S&P 500. So you can buy both. There will be overlap on the US component, but then on the other 6 regions, there won't be overlap. Brian, great question. The role of the market maker. So I'm going to do a whole webcast on this, but market makers, essentially, their role is that the ETF has a fair value, right? And that fair value is quite simple to determine. It's the value of all the shares within the ETF. And then if we want to bring it to rands, we then also got the different exchange rates. And that then gives us a rand fair value for that ETF. And let's say, for ease, I'm going to say it's 50 rand. What the market maker then does is they then sit either side of that 50 rand as a buyer and a seller. So they'll be selling at, say, 50 rand and 20 cents, and they're a buyer at, say, 49 rand and 80 cents. And what that means is that when we're buying and selling that ETF, we're getting just 20 cents above or below the fair value for that ETF. Now, if someone is sitting at a better price, we will get that better price. Now, if there's a seller at 50 rand, and the market maker is at 50 rand and 20, well, we will get the 50 rand. What they're then doing during the course of the trading day on the JSE is, as the underlying shares are changing in value, so is that index, and they adjust accordingly. And as those currencies are changing in value, so does the fair value, and they adjust accordingly. So the market maker is in real time updating their buy and sell prices to make sure that we are trading just around there. EJ, yep, mail me about bonds. Actually, we should do some bonds one. Andrew, with SARB approval, you can send 10 million out of SA every year. So therefore, the average person shouldn't need to invest in local ETFs that invest in the S&P indices, as tax is more onerous. Why do you prefer the local feeders? First point, Andrew, this one particularly isn't a feeder, but I take your point on it. So a couple of points on it. The first is just, for a lot of folks, it's the simplicity. Our tax-free account is a South African domiciled, so we can't put New York purchased assets into a tax-free account. But for a lot of folks, they're going to go off to New York, as you say. You can take $1 million with no questions, another 10 million if SARB gives approval. So for most people, that's way more than you need. Question from Fred, difference between a feeder fund ETF versus the same in a country direct S&P versus feeder fund. So Fred, what a feeder fund is a feeder fund is, rather than the ETF issuer going and buying those 1,200 different shares, is they could just go and buy those different ETFs that make it up, or they could just buy one. Let's use the S&P as an example because it's simpler. So what you can do is, you simply, as an issuer of a S&P 500 ETF, you can go and buy the 500 shares that make up the index, put them in the basket, and sell them to the individual. A feeder fund is where, instead of buying those 500 shares, is you go and buy a ETF in New York that tracks that already. So in other words, there's a third party, usually someone like iShares or BlackRock, one of those big companies, Vanguard. You go and buy their ETF so that the local issuer doesn't have to buy all the shares. That is then done by BlackRock or Vanguard or whoever. Robert, always a pleasure. Mike, Fourth Industrial, yep, that's a great one. We're getting a lot of questions for Fourth Industrial. Treasury bonds, Greg, yeah, let's do some bonds. I mean, so I'll do bonds from a couple of aspects, because there's a couple of ways we can get bonds. As individuals, going and buying a government R186 is not easy, but there are ways. So yep, I'll add bonds to the list. Russell, should I own it in my OST account as well as my tax-free? Or should I put S&P 501? So I'm a little lazy here. I max out my tax-free. I buy the Ashburton at 1,200, and then every month via ASI I do a debit order and I go and buy some more of it. But what you're suggesting is put maybe the ASH 1200 in your OST, your discretionary, and the S&P 500 in your tax-free. You certainly can. And which one goes into tax-free, which one goes into discretionary, we don't know. I mean, truthfully, in 20 years' time, when we look back at today, one of those ETFs has done better than the other. Which one? Honestly, don't know. We don't know until 20 years' time. The point, and I made it earlier as well, is that the Ashburton 1200 does have those extra 700 stocks, therefore giving you a more direct regional exposure. Limco, how many ETFs should one have in order to have a balanced portfolio? That's a great question, and I think I'm going to add that to my list as well. So I'm going to give you two answers. The first answer is, if you buy something like if you buy a global ETF, you've got certainly a diverse portfolio in terms of geography and in terms of sectors and in terms of currencies. You've absolutely got that. What you haven't got, however, is different asset classes. There's not much property in these ETFs. There's very, very little cash. There's no bonds in the ETFs. There's no commodities in the ETFs. So you're diverse in terms of geography, sector, currency, but you might want to add a little bit on the tail in terms of other asset classes. But certainly, and if you're a youngster with a lot of time on your side, in other words, time to retirement in a sense, at 1,200, something like this, or even an S&P 500, massively diverse. Greg, on a monthly contribution, is a minimum investment or a minimum once-off payment? Not sure where you're talking monthly. Oftentimes they are, and often those are linked in terms of the transaction fee, which has a minimum. If you're putting it into a tax-free moot, but I'm not quite getting your question. Resend it. I'm not sure which platform you're talking about in terms of minimums. Can set up daily, weekly, or monthly using OST Money Market to add to the portfolio. So you can't do it on a debit from the online share trading. That you do within AutoShare Invest. We would do some webcasts on AutoShare Invest. Within the online share trading, you would need to practically go in and make that purchase yourself. Brian's asking about the NASDAQ ETF listed locally. Absolutely been one of the best performers, tech heavy, and make no mistake, the story of the last decade has all been about tech, and it'll be one that we will certainly cover in a future Friday. Alan, can there be liquidity shortages? Short answer, no. That's the beauty of an ETF. The market maker is there, and they're going to provide that liquidity for us in their buying and selling. Is there overlap with Fourth Industrial and NASDAQ? NASDAQ, there is some overlap, less with the Fourth Industrial. The Fourth Industrial is a weird one. Last time I checked it, its big holdings were weapons manufacturers and GoPro and weird stuff. But certainly with NASDAQ, a lot of those NASDAQ 100 will be in this ETF as well. Why is the rhodium ETF increasing so rapidly from the recent crash? I imagine rhodium prices now moving again. Is it possible to short ETFs with CFDs in South Africa? Alan, great question. I'm honestly not sure, and there's an easy way to find out. I mean, hop onto the online share trading platform, go to the ETF quote page, and it'll say CFDs associated, and see if you can short. Last question from Greg. Thoughts on Berkshire Hathaway cash holdings? Yeah, so I mean, now things get interesting. So what? They're sitting on $122 billion, which is a staggering amount of money. And now maybe he's going to start spending some of it, Greg, because a lot is cheap. I think they're going to be a lot of distressed businesses. What he might not do is go and buy entire companies, but, you know, a company, and I remember, and I can't remember which bank, it was a Bank of America, one of the banks in the 2008 crisis, they had a liquidity crunch. So they sold him options, warrants, which he then converted into shares. But what they did was he got them at a good price because the bank desperately needed some cash. So I think there's opportunity for Berkshire here to perhaps pick up, if not 100% of a business, certainly some big stakes in businesses. Ladies, gents, we'll park it there. We want to try and keep these at under half an hour, including the Q&A, and we're just hitting that. We'll be back again Monday with myself and Dineo. We'll be talking markets. Week that was, it's been a crazy week. The week that's coming up, who knows what next week will be about. 10:30, and then Wednesdays and Fridays. And as I said, we'll get those Tuesdays and Thursdays in as soon as possible. Everyone, for your time. Stay safe, stay locked down, and don't forget, wash your hands. Cheers all.